Thank you very much. You'll be relieved to hear, since we're starting late, I don't think it lasts long now. I first became aware of the idea that property didn't always go up in 1988. I was in Houston, Texas, and I went on a tour with a realtor, as they call them in America, a real estate agent, of apartments for sale. The local economy had caved in with the decline in the price of petroleum. The broker showed me block after block of deserted homes, many abandoned by fleeing owners who had defaulted on their mortgages. These were apartments that could be bought for as little as $15,000, a fraction of their previous value, a fraction even of what they cost to build. Their various owners had done bunk overnight, leaving toys, photographs and clothes strewn all over the floor. The wreckage, effectively, of a life left for the bailiffs and bank to throw in the trash. It was a sad and sobering sight. This was the downside of home ownership in a boom-bust oil state like Texas. Unfortunately, in the 21st century, whole countries have turned into property boom-bust states. Places like Ireland, Spain, and of course America. Really, for the first time in its entire history, over the last 8 years or so, the USA experienced a truly nationwide property roller coaster, and the whole world is feeling the consequences of that. Of course, in many ways, America was colonized as a giant piece of land speculation, and it has undergone many regional slumps in the past, from Florida to California. Every generation, indeed, has its own real estate mania. The railroads and their grant of land, subdivisions, the new housing around sunshine cities like Las Vegas or Phoenix. But this time truly was different. The depth and breadth of the inflation in prices and the gruesome deflation since 2007 has been on a scale never before seen on Earth. The Case-Shiller Home Price Index increased 7.9% in 2001, 12.2% in 2002, 11.3% in 2003, 16.2% in 2004, and 15.5% in 2005. In certain respects, the housing boom there was greater than the stock market boom that preceded it. And indeed, the dot-com bubble and subsequent burst only directly affected a fairly small proportion of the population who own mutual funds or worked in technology companies. But by 2006, almost 70% of Americans own their own home and have been told incessantly it was a one-way ticket to riches. Moreover, and this is the great issue at heart about property, most homes are almost invariably bought using mortgages, and this time round, many properties were financed 80, 90, or even 100% using debt. So the scale of exposure was vastly greater, and the concomitant scale of notional losses in the last few years was similarly much bigger than with the dot-com bust. It's now estimated the overall losses on American property are in excess of $6 trillion. The economic and social impact of foreclosures, bankruptcies, evictions, insolvencies, and unemployment arising from this collapse should not be overstated. Policymakers, capitalists, lenders, academics, builders, and indeed homeowners must learn from this wild and ultimately disastrous journey. Although here in London we appear to have avoided a property crash like the one in the US, nevertheless societies like ours in Britain are far, far too addicted to property ownership and investment, and we must learn to wean ourselves off this dangerous habit if we are to prosper in the coming decades. The housing boom was almost entirely negative in its effect. It diverted resources from more productive parts of the economy. It lulled people into borrowing and spending too much. It led to wasteful overbuilding. It created widespread insolvency in the banking sector. It fostered rampant fraud among valuers, brokers, borrowers and others. And it has made homeless hundreds of thousands of families and undermined whole communities. The impact will be felt for many years to come as banks are recapitalised, workers learn new skills, families break up because of the agony of eviction and homelessness, and derelict housing developments are literally bulldozed. It is estimated that by the time the entire cycle has been completed, up to 4 million homes in the US will have been repossessed. This year alone, probably 1 million will be foreclosed, with many of them ending up unwanted in the hands of lenders. Imagine the turmoil and knock-on effects of such disruption. It is a tragedy that so much suffering and so many shattered dreams can happen in what is still the richest country in the world in the 21st century. The Americans themselves are seriously questioning the fetish of home ownership. The front cover of Time magazine a couple of months ago ran a story entitled Rethinking Home Ownership. Many citizens now realise the inflexibility that comes with having bought a home saddled with a mortgage. Historically, Americans moved for work if jobs became scarce. Now that mobility is much reduced. Americans saw their property as a form of saving. Now many see it as millstone. Critics argue that high home ownership has contributed to the hollowing out of cities and suburban sprawl. Closer to Britain, another country which has been poleaxed by the illusions of easy money derived from property ownership is Ireland. There, the low interest rates, ushered in by the arrival of the euro, helped set off a frenzy of commercial and residential property speculation. At its peak in 2006, in Ireland, there were 90,000 new homes built for a population of 4 million. In Britain, with a population of 60 million, there were just 150,000 new homes built that year. A cozy cartel of badly managed and under-regulated banks in Ireland has devastated their economy. They lent money to house builders and developers as if they were on crack cocaine. One institution, Anglo-Irish, epitomised the madness. This is a bank, or was a bank, that has a 75 billion euro loan book, of which right now only 12 billion euros are performing. The Irish government has already had to inject 22 billion euros in aid, but the final bailout for the Anglo-Irish Bank alone may exceed 25% of the total Irish gross domestic product. The profligacy is illustrated by a deal done in 2007 to buy a 25-acre industrial plot in Dublin for 412 million euros, of which Anglo-Irish lent 300 million euros. The site is now estimated to be worth just 20 million euros, suggesting a decline of 95% from its peak value. To attempt to dig its way out of the mire, Ireland has had to increase taxes and slash public spending, while unemployment has trebled in 2 years to 17%. In the last couple of weeks, Ireland has had to go for a bailout to the IMF and EU Central Bank to borrow in excess of 100 billion euros to shore up its insolvent banks, all of which were done in by property. The next few years in Ireland promise to be a grim time as the Irish pay the awful price for a near fatal love affair with property. Historically, Ireland has had a very high ratio of home ownership, as did Spain. And the Irish also caught the second home bug in a major way. Many are now paying the price for their obsession with bricks and mortar, and indeed debt. And debt is in a way at the very heart of the problem with property. Banks and other financial organisations are far too keen to lend against property and not as interested in more important, in some ways, undertakings like businesses that provide jobs and generate trade and export. There is no future for any nation in being brilliantly housed if we are all unemployed and have taken on giant mortgages we cannot afford to service. Now, Britain has escaped at least some of the worst devastation of the global property slump thanks to ultra-low interest rates. Cheap money is propping up prices because mortgages have become imminently more affordable. Also, limited land and tight planning laws mean there is nothing like the surplus of unsold vacant new homes, which bedevil the American and Spanish markets in particular. It is, for example, believed that there are 1 million unsold Spanish homes and over 2 million unsold American ones. But we should not be complacent. Over many decades, property inflation here means we have some of the most expensive real estate in the world. A very high proportion of our overall capital stock is tied up in our homes. Britain's pensioners, for example, own a grand total of £775 billion of residential property. But does that ownership make us globally competitive? Does it provide jobs or exports? Does it help solve our trade deficit? And are they really worth £775 billion? A knock-on effect of a society intoxicated by property is that the finance sector becomes bloated. Because property invariably needs debt, so banks and financiers spread like the bubonic plague where people are property mad. Funding, trading and developing property crowds out other, more beneficial professions and forms of work and business. Since the 1960s, this is what has happened in Britain. We've moved away from making goods and become a nation of buy-to-let landlords. I have experienced the insidious effect of inflated values. Businesses I know have having had to sell their industrial sites for houses because the development gains far exceed the possible returns from factories that made things and where people were actually employed. I'm not advocating a return to new council estates and away from mass home ownership or giant programs of construction of new social housing. Homeowners do tend to have a proper stake in their community, and in a way it is a form of forced saving. But we have gone too far in our worship of property, and we need to rebalance. Perhaps the market is actually doing some of this adjustment for us. I suspect the price of residential property here will stagnate for some years to come. This uncomfortable, for those who own property, but necessary process will allow incomes to catch up with house prices just somewhat, and means homes will become more affordable to those who want to own one. And if properties go nowhere for a long time, it will surely, over time, discourage much of the speculation that drove the bubble. But when interest rates one day rise, which they surely will, and quite often it happens rather sooner than people expect or want, then we should be afraid. More than almost anywhere else, here borrowers have floating rate loans, and materially higher interest rates would bankrupt thousands and potentially even millions of people with mortgages that they can barely afford currently. Consumers here have almost more debt per capita than anywhere else on earth, much of it tied to property ownership, of course. We are on a life support system of ultra-low interest rates, but a collapse in currency, if it were to happen, and deadly imported inflation, which would follow, and to which we are almost uniquely vulnerable because of our high levels of trade, may mean that the Bank of England would have absolutely no choice but to hike up interest rates to protect sterling. If that were to happen, then the number of annual repossessions would soar from their current 40,000 a year. The government is acutely aware of how vulnerable we are as a nation to rising interest rates, and will doubtless do anything they reasonably can to ensure rates stay low. But as has proved recently in places like Ireland, events can spiral beyond the control of a domestic government. Now, Germany does not worship property in the same way as we do here in Britain and they do in America. They're just 40% of citizens rent their homes. It is seen as a perfectly respectable and pragmatic thing for middle-class citizens to do. Meanwhile, residential property in Germany has hardly risen in value at all in real terms for many years. So citizens
do not see it as a particularly great investment. They see homes as a place to live. Of course, they benefit from having a large landmass and a number of regional centres of wealth and industry, rather than the overdependence we have here in Britain on London and the cramped southeast. And Germany is also, and probably not by coincidence, a powerhouse of manufacturing and exports, and has held unemployment at far lower levels than they have, for example, in the US. Arguably, in Britain and the US, property has crowded out other asset classes, so that capital has flowed into houses and shopping centres and not plant, machinery and technology. Unfortunately, America depended far too much on construction and property-related jobs in recent years, many of which simply disappeared when the market crumbled, as California proves to an extreme degree. Germany also, as a nation, enjoys far lower levels of debt, personal, government and corporate, than we do in the UK. And they are overall much better placed to withstand this recession, despite their high wages and high cost of living, because they have far less leverage and a much better invested industrial base. We are weighed down by our deep love affair with property and all the inevitable borrowings it brings with it. It seems to me the lessons of the property bust are straightforward. We should not subsidise and over-encourage home ownership. It does not lead to a productive use of resources and ends up with citizens taking on too much debt and buying homes they cannot afford. An obsession with property ownership is unhealthy and distorts behaviour in destructive ways. Bright, educated citizens spend more time thinking about the price of their home than perhaps even the happiness of their children. Too many companies here are valued on the basis of their real estate rather than their ability to generate continuing profits or provide decent jobs. I accept there is something very basic about people wanting to own their own home, about the solid nature of bricks and mortar as an investment. But as we have outsourced more of our industry, so we have come to rely on property more and more as the only store of value. But actually, property costs money to maintain and is subject to council tax or rates, while transaction costs like agents and legal fees are relatively high. Those under 30 these days can barely afford to buy a home, while those over 50 often own far more property than they can reasonably use. As David Willits points out in his excellent book, The Pinch, the baby boomers have most of the assets, property and pensions, and the younger generation has very little indeed. And unless we want serious intergenerational strife, then somehow property must be made more accessible for those under 30. Japan is a very stark example of what happens when the cult of property reaches extreme levels. They have still not recovered from a monumental property mania, possibly the worst the world has ever seen, that existed there in the late 1980s. I'll remind you that in 1991, the value of the Tokyo Royal Palace was reputed to be more than the value of the entire state of California. After that moment of hubris, nemesis has taken its toll on Japan for 20 years, with particular Japanese real estate. Prices have fallen almost 70% from their peak and are back at 1983 levels. The incredibly hard-working and well-educated Japanese have been suffering from a stagnating economy ever since, with shell-shocked investors, insolvent banks, and a colossally over-borrowed government. This asset deflation has scarred a whole generation of Japanese and induced a culture of pessimism, fatalism, and reduced expectations amongst the young. In fact, today, Japan's economy has a GDP of 5.7 trillion, exactly the same size it was 20 years ago. During that period, most of it before America fell so in love with property, America's has doubled. Property debt traps can take an incredibly long time to escape, and the Japanese, also thanks to their demographics, have not yet succeeded in escaping. So in order to tackle our property craze, and in the interest, I suppose, of being a little provocative, I have proposed a few possible policies that our leaders might wish to consider. Firstly, I think the profits from the sale of any residence, doesn't matter whether it's your principal private residence or whatever, should be subject to capital gains tax, just like the surplus proceeds from the disposal of any other asset. There should be no exemptions. Secondly, I think interest on mortgage payments on a home should not be tax deductible. Now, this form of tax relief has already been withdrawn correctly in Britain, but it remains up to the value of a $1 million mortgage in the US and is estimated to cost the US Treasury $131 billion per annum. And I think they should abandon it. Lenders, in general, should not rely too heavily on automated valuation and loan processing technology to grant mortgages, as they have particularly in America. Their new low-cost computerized systems for approving loans has helped lead to terrible mistakes being made by their banks. I think, as they are in the UK for the most part, all home mortgages should be ultimately personally guaranteed by the borrower. In the US, many mortgages are non-recourse, actually permitting borrowers to simply walk away from an underwater loan with no penalty other than an impaired credit rating. I think the sanction of guarantee helps produce a higher level of responsibility among borrowers and indeed leads to less reckless borrowing. I think all banks should be restricted in the proportion of their assets they devote to property lending, be it commercial or residential property. And I think that should include the proportion of security they take that is bricks and mortar, because of course a great deal of what is apparently not property lending is backed by property. I think banks should be required to lend more to industry for investment in productive business assets that can generate jobs, exports, and create wealth. I think property lenders should be required to make prudent loans and demand that borrowers, in general, if they've taken on a mortgage for a home, put down deposits of at least 20%, with very limited exceptions indeed. If people have little to lose because they've invested nothing in a home, then they are more likely to be tempted to overpay for a price and walk away from the mortgage if it all sours. In 2006 in the US, for example, 1 in 3 homeowners put no money down. The moral hazard that creates was certain, almost, I would argue, to lead to misery and collapse. I think lenders should revert to traditional ratios when they grant mortgages for homes. 3 times income based on authentic proof, rather than dangerous stuff like self-certification of 5 times income, or liar loans as they became known in America. I think planning in the UK should be loosened for new affordable houses. This will have the effect over time of increasing the supply of housing stock and so depress further the likelihood of house price inflation of existing homes. But planning permission should also be subject, I think, to higher fees or perhaps a windfall tax on those that achieve valuable new planning permissions. This would also make land ownership and development less lucrative for developers and perhaps, therefore, help steer investment towards more useful, productive sectors. I think consideration should also be given to second home council tax at a higher rate. I think this might discourage second home ownership, which can lead, as we know, to distortions of supply and prices, places like Cornwall. I think any tax so raised from those various initiatives would have to be pumped by hypothecation into new social housing, ideally to be built on brownfield sites, or possibly even to be used to reduce national insurance, which is a tax on jobs. I think consideration should also be given to a 5 or even 10% rate of VAT, or simply a higher rate of stamp duty on housing transactions. But I think first-time buyers should be exempt from this sort of tax. I think this would then help first-time buyers get a foot on the housing ladder. Now, curiously, I think the market is already steering people towards a more sensible approach. Property prices, both here and in the US, are, as I said earlier, unlikely to revive for some time. Home ownership will not prove this time round, I believe, the one-way bet it has been for so many decades. More owners will be forced to rent out their houses, and that will increase the supply of rented accommodation. And families may well over time turn to renting, since ownership may become less attractive over time. And perhaps in a few years, we can resume a rather more pragmatic and rational relationship with property. We will see it overall in a more utilitarian and less emotional light. Banks, I suspect, will have been so burnt by the bad loans on property in recent years that they will not treat it as a sacrosanct asset for security purposes. And we can therefore channel the savings and energy so available into more productive areas like industry. We sit here today in the Royal Society for the encouragement of the arts, manufactures and commerce, and I think it's a suitable venue for a request from me to switch our efforts and investment away from pure bricks and mortar and towards those noble pursuits like manufactures and commerce on which this great institution was founded. Thanks for listening.
Well, thank you for that, Luke. One statistic that wasn't in your speech I would throw into it as well is the way that house prices contribute to inequality. I think the latest statistics show that the gap between the 10th percentile and the 90th percentile in terms of asset ownership in London makes us the most unequal city in the world, and that's largely as a consequence of the things that you've been talking about. What I guess intrigued me about the speech was I think I counted 3 new taxes and several new regulations. Now, I know your general view about taxes and regulations. Does this indicate, do you think, really big differences in terms of how the business community as a whole thinks about the best interests of this country? That those who want to invest in industry and manufacturing and entrepreneurship, really now there's quite a big schism between them and the instincts of the financial services sector.
I don't know if that's true. I mean, I deliberately threw out a number of possible suggestions in, as I said, a slightly provocative way, and I entirely agree with you. In general, I'm not in favour of higher taxes and more regulation, but I do feel that Britain has gone far too far in its love affair with property, and if people aren't going to adjust their behaviour automatically, which I'm not convinced they will, then I guess it's up to government to try and encourage them to invest more of their savings in things like industry, domestic industry, which creates jobs. And, this is the only way, I believe, the private sector receiving investment and thereby creating new jobs, that we will find the replacement employment for those jobs that are being lost in the public sector. And unless we want to end up with a very high level of, permanent unemployment, which I believe produces more misery than virtually anything else one cares to mention, and leads to a generally unhappy society, then we must do all we can to stimulate the private sector. And I think that means a serious realignment of our priorities and beliefs away from obsession about property ownership. And I can't pretend that there are dozens of industrialists who've queued up to make this point to me. These are my observations over a number of years, and I think it's certainly not unique. And I think, although we've had the property love affair for perhaps longer than some, America has had it in an extreme way in recent years. Ireland, where some years ago it was very difficult to borrow money, had a horrendous love affair with property, as has Spain. They are suffering more than we are, but as I stated, I think we are vulnerable, and I think we need to shift our priorities in this area, because otherwise the consequences could be severe. And I think the example of Japan, although things are not entirely the same as our society, is a case in point. And the extraordinary values of property in this city, for example, are very, very difficult to justify.
Can I just ask one last question, I'll open it up, which is, as an investor, do you think that there is scope for the emergence of a different kind of private rented market? When you talked about a nation of buy-to-let entrepreneurs, those buy-to-let flats, they're pepper-potted around the place, they one-year leases, they're not terribly attractive. The kind of sense is that private renting is insecure. Now, the scope for a private rented sector where people are living together with good facilities, with 3-year leases or whatever, do you think that there's scope for a more attractive private rented sector to emerge in the economy? And could you imagine investing in such a proposition?
Well, as I said, I think that we really need to start by aligning investment interests up that people find investment in businesses and organisations that create jobs as a more attractive home for one's money. I do agree that a healthy private rented sector, which, for example, Germany has, is a good thing. As I understand it, the German private rented property sector is quite heavily regulated, and that's partly why I think people find it attractive to rent. And it may be that there needs to be a little bit more regulation in certain areas. It's a very difficult area to regulate. I accept that in the 60s and 70s, there was excessive regulation of private rented sector. It almost destroyed the sector. We don't want to go back to that. I accept that. These are very difficult areas, and there are a lot of unintended consequences. And I can't pretend to be a specialist housing economist, but these were merely my observations from a period that I think anyone would admit where the West, and in particular a number of countries like those I mentioned, have made horrible mistakes about their priorities for capital stock and investment, and it's had devastating consequences.